Welcome back to WealthWise, the podcast where clarity meets strategy, helping you navigate the often confusing world of personal finance and career growth. I'm your host, Sarah. Today, we're diving deep into a topic that I believe resonates with so many of us, especially those who've poured years into their education. We're calling it the degree deception. Why your diploma isn't a direct path to financial freedom. It's a provocative title, I know, but it's a conversation we need to have. By the end of this episode, you're going to walk away with a much clearer understanding of 1, why the traditional good grades, good job, retire well model is frankly crumbling for many. 2, the crucial, often overlooked difference between simply earning money and actually building lasting wealth through ownership. And, most importantly, some actionable first steps you can consider today to start shifting your mindset and your habits to break free from the grind and move towards genuine financial independence. And to help us unpack all of this, I'm thrilled to have an exceptional guest in the studio. He's a seasoned financial strategist, a passionate advocate for financial literacy, and someone who truly understands the nuances of building wealth in today's economy. Please welcome the insightful, the brilliant Max Wise. Max, welcome to WealthWise. It's a real pleasure to have you here.
Thanks so much for having me. I'm excited for this conversation.
Me too. So, Max, let's jump right in. We're often taught, almost from childhood, that if we study hard, get those good grades, secure that good degree, then a good job and financial success will naturally follow. It's a deeply ingrained societal narrative. But you argue, and I've seen the evidence in your work, that this path is becoming increasingly flawed, or at least incomplete. Why is this topic, this traditional advice, so misunderstood in today's landscape?
That's an excellent question, Sarah, and it gets to the heart of the matter. You're right, that belief system, study hard, get a degree, climb the corporate ladder, save a bit, retire comfortably. It's a narrative that served previous generations relatively well, and for a long time it was largely true. The path was clearer, more linear. But the socioeconomic landscape has shifted dramatically, almost seismically, in the last few decades. The rules of the game have changed, but the playbook many people are still using is outdated. One of the biggest misunderstandings is equating a high salary with wealth, or academic success with financial acumen. They are not the same thing. I've met countless individuals, doctors, lawyers, engineers, people with PhDs and master's degrees who are incredibly intelligent, highly skilled in their professions, earning six-figure incomes, yet they're living paycheck to paycheck. They're what I call high earners not rich yet, or HENRYs. They have the income but not the wealth. They haven't built assets. You see, the traditional system primes us to become excellent employees, excellent technicians in our fields, but it rarely, if ever, teaches us about money itself, how it works, how to make it work for us, the power of investing, the critical importance of financial literacy. We're taught how to earn it, but not how to grow it or keep it effectively. And this leads to some common and often detrimental misconceptions. For instance, the idea that saving is the same as building wealth. While saving is crucial, simply parking cash in a low-interest savings account in an inflationary environment means your money is actually losing purchasing power over time. Or the misconception that cutting out lattes will lead to financial freedom. While mindful spending is good, it's often a distraction from the bigger levers of wealth creation, like increasing earning potential through new skills or investing strategically.
That point about high earners not necessarily being wealthy is so powerful. Can you give us a more concrete example, perhaps a case study that illustrates this disconnect?
Absolutely. I often encounter, let's say, a couple, both highly educated professionals. Let's imagine they're doctors or perhaps a lawyer married to a tech executive. Together, they're pulling in, say, $400,000 a year. On paper, that sounds fantastic, right? They're living the dream. But then you look under the hood. After hefty taxes, which hit W-2 employees the hardest, significant student loan debt from those advanced degrees, a mortgage on a large home in a desirable neighborhood because, well, they've earned it, payments on 2 luxury cars to reflect their status, private school tuition for the kids, expensive vacations, and the general lifestyle inflation that tends to accompany higher incomes. They find themselves with very little left over at the end of the month. Sometimes they're even accumulating more debt to maintain that lifestyle. They look successful, and by societal standards of professional achievement, they are successful. But financially, they're often on a treadmill, working incredibly hard just to stand still, or worse, slowly sink. They haven't built a foundation of assets that can generate income independently of their jobs. They're completely reliant on their next paycheck. If one of them loses their job, or if there's a medical emergency, the whole edifice can become very precarious very quickly. This isn't an isolated scenario, it's a pattern. It highlights that conquering the educational part of your career doesn't automatically mean you'll conquer the financial part. There's another layer of education, financial education, that's often missing. And without it, even the brightest minds can find themselves trapped. This isn't about blaming anyone, it's about recognizing a systemic gap in what we're taught versus what we need to know to thrive financially in the 21st century.
That's a sobering but incredibly important picture you're painting, Max. It really sets the stage for why this conversation is so vital. It's clear that just having the degree and the good job isn't the complete answer anymore. So if that traditional path is flawed, what are the core insights, the fundamental shifts in thinking and action that our listeners need to understand to start building real, sustainable wealth? What are the tactical moves? And perhaps equally important, what are the things to avoid?
Max, you've painted a very clear picture of how even high earners can find themselves in a precarious financial situation. It really underscores that the traditional path isn't a guarantee. So let's dig into that a bit more. You mentioned the limitations of relying solely on a salary. Max, you've touched on how even high-income earners can struggle. What are the inherent limitations or traps of relying primarily on a traditional salary to build wealth?
That's the perfect place to start, Sarah, because understanding these traps is the first step to avoiding them. The salary trap, as I call it, has several layers. First, and perhaps most obviously, is the vulnerability of a single income stream. When your entire financial well-being is tied to one W-2 job, you're essentially balancing your life on a single point. Think about it. If you get sick and can't work for an extended period, if you're unexpectedly laid off, which we've seen happen to even the most loyal employees in major companies, or if your company itself goes out of business, that income stream can dry up overnight. But your expenses? They don't just magically disappear. Your mortgage or rent, car payments, utilities, groceries, your kids' needs, those bills keep coming, relentlessly. Suddenly, you're in a defensive crouch, trying to survive rather than thrive. We saw this starkly for many during the pandemic. Second, there's the inherent cap on salary growth for most people. While we all hear stories of CEOs with multi-million-dollar salaries, for the vast majority of employees, even highly skilled ones, there's a practical ceiling on how much their salary can increase year over year. You might get a 3% raise, maybe 5% if you're a top performer, or a bit more with a promotion. But the chances of your salary jumping from, say, $70,000 a year to $250,000 a year in a short span within the same employment structure are, for most, slim to none. You're trading time for money, and there are only so many hours in a day and only so much an employer is typically willing to pay for that specific role. So your ability to exponentially grow your income through salary alone is fundamentally limited. And third, and this is a big one that often flies under the radar for many, employees typically bear the highest tax burden. As a W-2 employee, your income is taxed as ordinary income, which is generally the highest tax rate. Our tax code, whether you agree with its structure or not, is often designed to incentivize certain behaviors, and investing is one of them. Investors often qualify for lower tax rates on their gains, think long-term capital gains tax rates, and have access to a wider array of tax deductions and strategies that simply aren't available to most salaried employees. So a significant chunk of that hard-earned salary is going to Uncle Sam before you even see it, making it even harder to get ahead purely on earned income.
That tax point is particularly interesting. It's almost like the system itself nudges you towards something beyond just earning a salary if you know where to look.
Precisely. It's not about demonizing jobs or salaries. They are often the crucial first step and the engine for generating initial capital. But if your only strategy is to earn a salary, you're playing a different game, with different rules and, frankly, different odds than those who understand how to leverage their capital as investors. It's about understanding the full board, not just one section of it.
That's a powerful summary. So to encapsulate that first insight for our listeners, highlight: your salary is a starting block, not the finish line. Relying on a single income stream is like betting your entire future on a single horse in a very long race.
Okay, Max, so we've established the inherent limitations of relying solely on a salary. Now, I want to touch on something you alluded to earlier, which might sound counterintuitive to some. You've shared that highly educated, professionally successful individuals, the smart people, can sometimes face unique hurdles in building wealth. What are these blind spots that can trip up even the most intelligent and accomplished professionals?
This is a fascinating and often sensitive area, Sarah, because it involves a bit of psychology. There are a few common patterns I've observed. One major blind spot is simply being too busy. Think about dedicated professionals like surgeons, corporate lawyers, or senior accountants. They've spent years, often a decade or more, honing their craft. Their jobs are incredibly demanding, often requiring 60, 70, even 80 hours a week. They are, understandably, deeply immersed in their careers. The thought of then having to dedicate significant time to learn about investing, portfolio management, or real estate analysis can feel overwhelming, like taking on another full-time job. So financial planning gets perpetually pushed to the "I'll get to it later" pile, which of course rarely comes. Another is a different kind of risk aversion than you might expect. These individuals are often very good at managing risk within their professional domain. A surgeon meticulously plans a procedure to minimize risk. A lawyer carefully crafts a contract. This is calculated, controlled risk. However, the perceived risk in financial markets, the volatility, the potential for loss, the unfamiliar jargon, can feel alien and far more daunting. Investing in a company that could go bankrupt feels like a vastly different and scarier proposition than studying hard for an exam, where effort generally correlates with success. I've personally invested in companies that have gone bankrupt, and I can tell you, it's a very different emotional experience than getting a bad grade on a test. And then, sometimes there's an element of intellectual pride or complacency. This isn't universal, of course, but I've encountered individuals who, because they have a PhD, an MD, or an MBA from a prestigious institution, subconsciously believe they should inherently understand money, or that financial matters are somehow beneath their specialized expertise. They might think, "I'm smart, I'm educated, I don't need to delve into all that financial stuff." This pride can become a significant barrier to seeking out the very financial education they desperately need. These blind spots, Sarah, often converge to fuel what we call lifestyle inflation. As their income rises, so do their expenses, often at an equal or even faster rate. We touched on the doctor couple earlier earning, say, $350,000 a year. After taxes, let's say they bring home roughly $230,000, which is about $19,000 a month. Sounds like a lot, right? But then the expenses pile up. The $7,000 mortgage on the impressive house the bank said they could afford. Another $3,000 for property taxes, insurance, and home maintenance. Then the doctor cars, the Escalade and the Range Rover, easily $2,000 a month in payments and insurance. Feeding the family, especially with busy schedules leading to more takeout or dining at nicer restaurants, can be $3,000. Travel, because they deserve those nice vacations after working so hard, another $2,000. And of course, the clothes, the jewelry, the stuff that signals success, maybe another $2,000. Suddenly, that $19,000 is gone or even exceeded. They're living an outwardly affluent life, but it's a house of cards built on continuous high income, with no real wealth accumulation underneath.
It's a powerful illustration of how easy it is for expenses to expand to meet or even exceed income, regardless of how high that income is. The golden handcuffs become very real.
Exactly. And it's not because they're bad people or financially irresponsible in a malicious way. It's often a gradual creep driven by societal expectations, peer pressure, and a lack of a clear financial plan or the financial literacy to see the long-term implications of these choices.
A critical point for anyone seeing their income rise. So the takeaway here is
Highlight. Professional intelligence doesn't automatically translate to financial wisdom. Your income can soar, but so will your expenses if you're not consciously managing the gap and resisting lifestyle inflation.
So, Max, if overspending, even with a high income, is a trap, what about the other extreme? Many of us are taught that diligently saving a large portion of our income is the safest path to financial security. If lifestyle inflation is one pitfall, what about those who are diligent savers? Is simply stashing away cash the answer?
That's a great question, Sarah, because it addresses another common approach. And let me be clear, being a good saver is far preferable to being a chronic overspender. That discipline is valuable. I sometimes refer to what I saw growing up in some traditional immigrant communities, like the traditional Indian lifestyle you mentioned in the outline, where the ethos was to earn $1 and save 80 cents. That frugality builds a cash cushion, which is important. However, while saving is a necessary first step, it's often not sufficient for true wealth building in the long run, primarily due to one silent wealth killer, inflation. Let's use the numbers you referenced from the original content, just for illustration as these rates fluctuate. Imagine the average interest rate on a standard savings account is a paltry 0.6% per year. Meanwhile, let's say the reported average inflation rate is 2.4%. Now, if you have $100 and you want to buy a basket of groceries that costs exactly $100 today, instead, you decide to be prudent and save that $100 in the bank. After 1 year, assuming that 2.4% inflation, that same basket of groceries now costs $102.40. Your $100 in the bank, earning 0.6%, it's grown to $100.60. So, in real terms, your savings haven't even kept pace with the rising cost of goods. Your money is effectively losing purchasing power every single day it sits there. You're working hard to save, but your savings are silently eroding. Now, some listeners might say, well, I use a high-yield savings account. I'm getting a better rate. And that's true. High-yield accounts are certainly better. They might even beat the reported average inflation rate. But there are a couple of nuances here. First, the average inflation rate is just that, an average. The inflation rate for things you actually buy and need, like housing, healthcare, education, certain food items, car insurance, can often be significantly higher than that reported average. So even with a high-yield account, you might still be treading water or barely keeping your head above it in terms of real purchasing power for essential goods and services. Second, even if you are beating inflation slightly, you're not typically seeing significant growth in your principal. You're preserving capital, which is good, but you're not substantially compounding it. This is where the investor's advantage comes into play. Investing, by its nature, involves taking on more risk than saving, but it also offers the potential for significantly higher returns over the long term, returns that can outpace inflation by a healthy margin and allow your money to genuinely grow and compound. Furthermore, as an investor, you can create new streams of income. Think dividends from stocks, rental income from properties that are not directly tied to you trading your time for money.
And, as we touched upon earlier, investors often have access to more favorable tax treatment.
So, saving is about defense, while investing is about offense in the game of wealth building.
That's a perfect analogy, Sarah. You need both, but you can't win the game playing only defense. Saving provides stability and an emergency fund. Investing provides the growth engine.
Crucial distinction. The key message then for our savers is
Highlight. Saving is vital, but letting cash languish in a low-interest account is like trying to swim upstream against a strong inflationary current. Investing is how you build a boat.
This is all incredibly insightful, Max. We've talked about the traps of relying solely on a salary, the blind spots that can affect even smart professionals, and the limitations of just saving. It's clear that neither just earning more nor just saving more is the complete solution. So what is the fundamental shift, the core principle that people need to embrace to truly start building lasting wealth and financial freedom?
The fundamental shift, Sarah, boils down to two interconnected concepts: embracing continuous financial education and deliberately moving towards ownership. Let's start with financial education. This isn't something you learn once and you're done. It's an ongoing process. And crucially, this is personal financial education I'm talking about. How to manage your money, your investments, your financial future. You won't typically learn this in medical school, law school, or even in many traditional business school curriculums, which might teach corporate finance, but not necessarily personal wealth strategy. It's about understanding concepts like asset allocation, compound interest, risk management, different investment vehicles, and how economic cycles work. This knowledge empowers you to make informed decisions, rather than relying on hearsay or getting caught up in the latest speculative frenzy. This education then naturally leads to the second concept, the shift from being solely a laborer to becoming an owner. Most of us start by trading our labor, our time, skills, and effort for a salary. There's nothing inherently wrong with that. It's how most people generate their initial capital. But the wealthiest individuals and families in the world didn't get there solely by climbing the corporate ladder. They got there and stay there through ownership. They own assets, businesses, real estate, stocks, intellectual property, things that have the potential to appreciate in value and/or generate income independently of their direct hour-to-hour labor. The goal, therefore, is to strategically use the income from your labor, your job, to acquire these productive assets. You're essentially converting your labor money into capital money. Think about figures like Warren Buffett or Bill Gates. Yes, they were brilliant innovators and business builders, but their enduring wealth comes from their ownership stakes in the enterprises they built or invested in. You don't necessarily have to start the next Microsoft or Berkshire Hathaway. You can become an owner by buying shares in great companies, investing in real estate investment trusts, REITs, or even starting a small side business that generates its own revenue. It's about understanding that in a capitalist system, and I say this apolitically, it's just understanding the mechanics of the game. Wealth is predominantly built and sustained through the ownership of capital, of assets. Your job can provide the seeds, but financial education teaches you how to plant those seeds and cultivate them into a forest of assets that can support you, potentially for generations.
That's a profound reframing, from just working for money to making your money work for you through ownership, fueled by continuous learning.
Precisely. It's about building systems where your assets are working around the clock, even when you're sleeping or on vacation. That's a very different paradigm from having to show up every day to earn every dollar. It's the path from financial dependence to financial independence, and ultimately to financial freedom.
A powerful vision to work towards. And the final core insight for our listeners to take away from this section?
Highlight. Don't just trade your time for money indefinitely. Use your earnings to buy assets and reclaim your time. True financial freedom is built on the foundation of ownership, guided by lifelong financial learning.
Max, your insights throughout this conversation have been incredibly profound and I think eye-opening for so many of us.
We've talked about the theory, the strategies, the common pitfalls, but often the most impactful lessons come from personal experience, from those moments that really shape our perspective. Was there a specific turning point in your own financial journey, perhaps a mistake, a loss, or a breakthrough moment that truly solidified this understanding of wealth and financial education for you, something that changed how you think forever?
That's a great question, Sarah, because theory is one thing, but lived experience often provides the most indelible lessons. And yes, there was a period, a sort of extended moment, that deeply shaped my philosophy. As you touched upon from the outline, I grew up in a traditional household where academic achievement was paramount, and the prescribed path was very clear. Doctor, lawyer, engineer, those were the gold standards. My parents, with the best intentions, had me prepping for the MCAT, the medical college admission test, when I was still in middle school. The pressure was immense, born out of their desire for me to have security and status. However, as I got a bit older, into my late teens and early college years, I stumbled, almost accidentally at first, into the world of finance and investing. It was like discovering a hidden language that explained how the world really worked, or at least how the economic engine hummed. A whole new universe opened up, one that wasn't discussed at the dinner table or in my pre-med classes. The concepts of compounding, asset allocation, cash flow, market cycles, it was all utterly fascinating and felt intuitively powerful. The breakthrough wasn't a single event, but more of a dawning realization that the path laid out for me, while well-intentioned, wasn't the only path, and perhaps not even the most effective path to genuine freedom and impact. I made the decision, much to my parents' initial bewilderment and perhaps disappointment, not to pursue medicine. To, as you said, keep some semblance of family pride. I did go to law school and became an attorney. I passed the bar. But my heart wasn't in practicing traditional law. I never actually worked a day as a practicing attorney in a firm. Instead, every spare moment I had during law school and certainly after was spent devouring books on investing, economics, business biographies, and market history. I started investing with small amounts of money, making plenty of mistakes along the way, of course. I remember one early investment in a hot tech stock that everyone was raving about. I didn't truly understand the company's fundamentals or its valuation. I just bought into the hype, and predictably it plummeted. It wasn't a catastrophic loss in monetary terms because I didn't have much to invest then, but it was a significant emotional and educational loss. It stung. It felt like a failure. That experience and a few others like it forced me to confront a hard truth. My academic intelligence, my ability to do well on exams and write legal briefs, did not automatically equip me to succeed in the world of finance. Being book smart in one area didn't mean I was street smart or market smart in another. It was a humbling lesson. The real breakthrough, then, was the commitment to lifelong financial self-education. It was the understanding that financial literacy is not a destination you arrive at, but a continuous journey. It's a distinct field of knowledge, as rigorous and as important as medicine or law, but one that directly impacts every single aspect of your life, regardless of your profession. It requires proactive seeking of knowledge, a willingness to learn from mistakes, and the discipline to apply that knowledge consistently. So, it wasn't a sudden windfall or a single brilliant investment. It was the slow, often challenging, but ultimately empowering process of realizing that the game of money has its own rules, and if you don't learn them, you'll always be playing at a disadvantage, no matter how smart or successful you are in other areas of your life. That understanding fundamentally shifted my trajectory and fueled my passion for sharing this knowledge with others.
Thank you for sharing that, Max. It's so relatable, that feeling of realizing there's this whole other curriculum to life that we're often not taught. And the humility in recognizing that expertise in one field doesn't just transfer. That's a powerful lesson in itself.
Absolutely. And it's a lesson I see many highly successful professionals grapple with. The willingness to be a beginner again in a new domain is crucial.
Max, looking ahead now, the world of finance and investing is constantly evolving, especially with advancements in technology and shifts in global economics. If you had to bet on one significant shift or trend in the next 3 to 5 years that will redefine or significantly impact how individuals, particularly our audience, achieve financial success, what would it be?
That's a great forward-looking question, Sarah. If I had to pick one overarching trend, it would be the accelerated democratization and personalization of financial empowerment, largely driven by technology and an increasing demand for transparency and access. Let me break that down a bit. For decades, sophisticated financial advice and access to certain investment opportunities were often the preserve of the very wealthy, gated by high fees, minimum investment amounts, and complex jargon managed by traditional financial institutions. That's changing, and rapidly. We're seeing the rise of accessible financial technology, fintech, that's putting powerful tools and information directly into the hands of individuals. Think about commission-free trading platforms, robo-advisors that offer algorithm-based portfolio management at low cost, and apps that help with budgeting, saving, and even micro-investing. This lowers the barrier to entry significantly. Coupled with this is the explosion of high-quality financial education content available online. Podcasts like this one, YouTube channels, blogs, online courses. Individuals are becoming more proactive in seeking out this knowledge, bypassing traditional gatekeepers. They want to understand how their money is being managed and why certain decisions are being made. So the trend I foresee is a continued, even amplified movement towards individuals taking greater control and ownership of their financial destinies. This will manifest in a few ways. 1, increased adoption of personalized investment strategies. Rather than one-size-fits-all advice, people will leverage technology and their own growing knowledge to tailor investment portfolios more precisely to their specific goals, risk tolerance, and even their values. Think ESG investing. 2, greater access to alternative asset classes. Historically, things like private equity, venture capital, or even direct real estate investments were hard for the average investor to access. We're already seeing platforms that allow for fractional ownership in real estate, art, or collectibles. This trend will likely expand, offering more diversification opportunities beyond traditional stocks and bonds. For example, fractional real estate ownership platforms are allowing people to invest in properties with much smaller capital outlays than buying an entire building. 3, the intelligent use of AI and big data in personal finance. While still in its early stages for individual use, I believe AI will play a larger role in helping people analyze their spending patterns, identify investment opportunities, optimize their tax strategies, and even receive more sophisticated, personalized financial advice at scale. Imagine an AI financial coach that understands your complete financial picture and provides real-time guidance. The caveat, of course, is that with greater access and more tools comes a greater need for discernment and genuine financial literacy. It's easier than ever to make mistakes if you're not well informed. But overall, I'm optimistic that this trend will empower more people to build wealth more effectively than ever before, provided they commit to that ongoing journey of learning.
That's a fascinating outlook, Max. The idea of truly personalized and democratized financial power is exciting. And as you said, it also underscores the enduring importance of that foundational financial education we've been discussing.
Precisely. Technology is a tool, knowledge is the skill to wield it effectively.
Max, this has been an absolutely phenomenal conversation. Thank you so much for sharing your wisdom, your experience, and your forward-thinking insights with the WealthWise audience today. I know I've learned a ton, and I'm sure our listeners are feeling incredibly inspired and, importantly, equipped with new perspectives.
The pleasure was all mine, Sarah. Thanks for facilitating such a great discussion.
So, to everyone listening, if today's episode of Wealthwise has sparked something in you, if you're feeling ready to challenge those old narratives about degrees and money, and if you're eager to take more control of your financial future, I want to encourage you to do 3 simple things. First, share this episode. If there's someone in your life, a friend, a family member, a colleague, who you think would benefit from hearing this conversation, please pass it along. Meaningful conversations are the bedrock of growth. Second, if you haven't already, please subscribe to Wealthwise wherever you get your podcasts. We bring you these kinds of strategic breakthroughs every week designed to help you build not just wealth, but a wealthier life. Leaving a rating and review also helps us immensely to reach more people. And third, and perhaps most importantly, make a commitment to your own financial education, starting today. It doesn't have to be a monumental task. Read an article, listen to another podcast episode on a topic that piques your interest. Start tracking your expenses with more intention, or research one new investment concept. Small, consistent steps compound over time, just like your money can. We've covered so much ground today, from the pitfalls of relying solely on a salary to the blind spots even the smartest among us can have, the crucial difference between saving and investing, and the absolute power of financial literacy and ownership. As you move forward from this episode, I want to leave you with this thought. Financial freedom isn't just a distant dream or something reserved for a select few. It's a strategy meticulously built on a foundation of knowledge, disciplined action, and the courage to think differently about your money and your life. Thank you for tuning in to Wealthwise. We'll see you next time.